Imagine discovering that the global financial system contains a real exploit, not a theory, not a rumor, a documented flaw that allows a small group of institutions to extract enormous wealth again and again without proportional risk and without meaningful consequence. This was not exposed by bloggers, influencers, or anonymous forums. It was exposed by the United States Department of Justice itself. In September 2020, JP Morgan formally admitted that it manipulated the gold and silver markets for nearly a decade. Headlines declared justice served. A historic fine was announced. Most people moved on. But that conclusion collapses under basic economic logic, because the fine was not a punishment. It was a licensing fee. And the system never stopped running. To understand why, you need to understand what spoofing actually is. Spoofing is not trading. It is not investing. It is not speculation. It is market manipulation executed at machine speed. The bank places massive orders it never intends to execute. These orders exist only long enough to distort perception. They create the illusion of overwhelming supply where none exists. Other traders see the sell wall, assume informed selling pressure, cancel bids, trigger stops, and sell. The price collapses. The fake orders are canceled. And the bank quietly buys real metal at the lower price it just engineered. This is not theory. It is documented behavior. Tens of thousands of instances across gold, silver, platinum, and palladium futures over 8 years. Systematic, institutional, admitted. And yet the only thing that changed was a line item on a balance sheet. The bank paid $920 million. That sounds enormous until you compare it to the profits generated by the desk during the same period. Estimates place those gains in the tens of billions. When a crime produces $50 or $100 billion and the penalty is under $1 billion, the incentive structure is obvious. The activity remains rational. The fine becomes a tax. No senior executives went to prison. No licenses were revoked. The trading desk survived. The message was unmistakable. Continue operating. Just price the penalty into the model. This is asymmetric justice. Retail traders face account destruction for minor rule violations. Systemically important institutions receive invoices. But spoofing was only the surface layer. The deeper problem is information asymmetry. When you open a trading app and look at market depth, you assume those orders represent real intent. You assume price is formed by actual supply and demand. The DOJ confirmed that much of that supply was fictional. That means price discovery itself was corrupted. This explains why silver experiences violent flash crashes without news, why rallies are capped with mechanical precision, why volatility appears and vanishes in seconds. These are not natural markets. They are managed environments. For years, this system functioned because nobody demanded the metal. Paper traded paper. Contracts settled in cash. The system fed on itself. But that world no longer exists. Industrial buyers want delivery. Sovereigns want reserves. Investors want ounces, not exposure. And this is where the exploit begins to fail. Because spoofing only works in a paper world. It collapses the moment physical reality is demanded. If Part 1 exposed the crime, Part 2 explains why it never stopped. Somewhere between 2020 and now, manipulation stopped being about profit and became about survival. Back then, spoofing was offensive. Traders crushed price, harvested liquidity, booked bonuses, and moved on. Today, the structure of the market has fundamentally changed. Vaults are draining. Industrial demand is structural, not cyclical. Banks are trapped inside positions that cannot be closed without destroying themselves. To understand this, you must understand the difference between a covered short and a naked short. A covered short is stable. If a bank sells 100 million ounces of paper silver and owns 100 million ounces in its vault, price volatility does not matter. The metal backs the contract. That is how the system was designed to work. But greed breaks systems. Over the last decade, banks sold vastly more paper silver than they could ever deliver. Hundreds of millions of ounces of synthetic supply were created because, historically, no one asked for delivery. Investors traded exposure. They did not want bars. The bank collected fees and controlled price. Then the world changed. Solar infrastructure expanded. Electric vehicles scaled. Military demand increased. Strategic stockpiling accelerated. Buyers stopped wanting cash settlement. They wanted metal. They stood for delivery. And when they did, the fractional reserve illusion cracked. Now imagine the position. A bank is short hundreds of millions of ounces it does not possess. Every dollar increase in price generates massive losses. A $10 move becomes billions. A $50 move becomes fatal. At a certain price level, Tier 1 capital is wiped out. Regulators intervene. The institution fails. This creates a solvency ceiling. A price level the banks cannot allow silver to cross. Not because it is expensive, but because crossing it mathematically bankrupts them. Every time silver approaches that level, massive sell walls appear. Not to generate profit, but to stop the clock. This is why spoofing today is more aggressive than ever. The algorithm is no longer farming traders. It is defending institutional survival. It floods the order book with fake supply to signal abundance in a market that is fundamentally scarce. It paints weakness to hide panic. But this creates a fatal paradox. By suppressing the price, banks accelerate their own destruction. When silver is artificially cheap, industrial buyers do not slow down. They accelerate, manufacturers lock supply, sovereigns accumulate, China drains vaults. The lower the price, the faster physical metal exits Western systems. Suppression drains the very collateral banks need to survive. Raising the price would slow demand and stabilize inventories. But they cannot raise the price because they are naked short. So they are forced to keep it low, which empties vaults faster, which guarantees default. This is a doom loop. Regulators understand this. Why does the CFTC tolerate it? Why does the DOJ remain silent? Because forcing honest unwinding would trigger a vertical repricing. That repricing would expose the scale of the short. It would ripple through equity markets, credit markets, pensions, and sovereign balance sheets. It would resemble 2008 without a bailout large enough to contain it. This is no longer corruption, it is containment. The exploit has become life support. But physics does not negotiate. Silver is finite. Demand is rising. Paper supply is infinite only until delivery is required. And delivery is accelerating. At some point, the algorithm fails. Cell walls stop working. Metal stops moving. The illusion breaks. And when it breaks, it does not fail gradually. It fails all at once. Delivery requests exceed available inventory. Exchanges invoke force majeure. Contracts are cash settled. Holders do not receive silver. They receive dollars. The paper market survives. The holder does not. Price discovery leaves the screen and moves to the street. Dealers quote triple digits. Industry outbids investors. Silver becomes unavailable at any price that matters. This is not a trade. It is a reset. Paper claims die. Physical metal reprices violently, and those who believe the number on the screen learn the oldest rule in finance. If you do not hold it, you do not own it. And there is one final layer most people still do not understand. This is not just about silver, it is about confidence. Modern financial markets are built on trust in abstractions. Trust that a contract will be honored. Trust that liquidity will exist when needed. Trust that settlement will occur as promised. Once that trust is questioned, the system does not bend, it snaps. What we are witnessing in silver is not an isolated anomaly, it is a stress fracture forming in the pricing mechanism itself. When physical delivery becomes uncertain, paper prices stop being anchors and start becoming suggestions. This is when markets decouple from models. This is when algorithms fail. This is when risk managers lose control because the assumptions baked into their spreadsheets no longer match reality. At that stage, price does not move rationally. It moves violently. It gaps. It overshoots. It reprices in steps, not increments. And the irony is brutal. The very institutions that suppressed volatility for years end up creating the most extreme volatility of all. The longer the price is held down, the more explosive the adjustment becomes. This is why these moments never come with warnings. There is no announcement. There is no countdown. One day liquidity is there. The next day it is not. One day contracts clear. The next day they do not. And when that shift happens, the people who relied on the system learn too late that the system was never designed to protect them. It was designed to protect itself.